Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, everybody. Welcome to this Thursday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Dennis Dick on the show today. We are in the midst of an earnings bonanza, a lot of earnings reports to talk through from this morning and after the bell yesterday. In no particular order, we'll get to Domino's, eBay, IBM, American Express. We have Microsoft and E-Trade after the bell. We have a lot of ratings to discuss as well. Cisco had some good news and a report of a potential or rumored merger between Wendy's and Papa John's. Our guest today will be at 8:15. We'll be joined by Gil Morales. He is the author of the Gilmo Report and the managing director at Mocha Investors. You can see I have the SPY chart up on the screen right now. We are trading down a little bit down to 280 this morning. Dennis, how is it going this morning?
It's going pretty good. Lots of news here. I mean, we're in earnings season here now, but even the analysts are busy here. Lots of ratings overnight. Got to be like 30 or 40 different ratings changes here. So it's been a busy morning here, Spencer. So I don't know where you want to start.
Well, they've got to catch up. I would think they have to. They were quiet there for a few weeks. You've got to play catch up now.
Yeah, and they got to comment on all these earnings reports that we're getting. So
let's
jump in here.
Yeah, let's start with the IBM. That one I thought was the most interesting.
Sure.
Of the day. They reported yesterday after the bell. Q2 adjusted EPS $3.08. That was a 4-cent beat on the estimate. Sales $20 billion versus $19.88 billion. So beat on that as well. They reaffirmed their guidance, their EPS guidance for the fiscal year came in 2 cents above the estimate. What I thought was most notable was the fact that it was the first time ever that more than half of their revenue came from the strategic growth areas. So the cloud and social. And mobile and analytics. This is the first time that happened, and the fact that they're growing in their growth areas, I think, is great news. And the stock kind of shows it this morning.
Yeah, that's what you want to see. I mean, this is a report. It seems like every time IBM reports, they get a pop and then they drop. This did not happen in this case. And I mean like a pop, and then within 10 minutes, it gives it back. And we know in the last report it was a disaster. We got up to over 160, running up into the report, and then Kaplooey falls down to 148. Was drifting down ever since, and did get the run here in July. Value tech kind of coming a little bit back into favor of some of the bigger old stocks. We talked about that move, and that kind of helped IBM as well. But like you said, they wanted to see some growth in their growth areas, and that's what they were seeing. So I think that the street looks like they're happy with the report. Now, you still have a lot of people who are underwater in this thing, so I don't think it's going to be easy sledding at all. I mean, we traded between 150 and 160, I feel like forever, in the back half of 2018. And even in the back half of 2017 and the early part of 2018. So I think the first hurdle for this has got to be 150. What does it do at 150? Can it get over? There's probably going to be some sellers there, some institutional sellers there. I'm not sure what it did in the after hours, if it snuck its head above there or not. But I would think the first resistance level, if it starts going rally mode, is going to be the 150 level. I'm just running to the book to take a look. I see 43,000 shares. It's the only level that does stand out, but it's early here, and a lot of institutions don't show their hand, but one is showing their hand. So I'd say 150, your first resistance point.
I'm seeing a pre-market high of 149.25. So,
yeah, they start getting up near those levels, those big hole numbers, and traders will take chances. I do too. I mean, you get up near the big hole numbers. That's where I was like, probably reverse. It'll be the same thing for Square today. Square catches an upgrade, going on a tangent here. And it's in the pre-market, it's kissed right up near $70. Probably going to struggle at 70 again because there is a big seller up there at 70 on SQ. If I go to the book right now, I can see 54,000 shares sitting up there at $70. It's never been there before. So, these big hole numbers just come into play. IBM 150, Square is going to be $70.
All right, let's move on. Got one from our chat here, Danaher DHR. So we'll go there next. The Q2 EPS $1.15 versus $1.09 estimate. Sales $4.98 versus $4.93 billion. So a beat on that, beat on both the EPS and the sales number for Q2. They raised their fiscal year EPS guidance by 5 cents on the low end of the range, from $4.38 to $4.43. That was the fiscal year EPS. The Q3 EPS came in pretty much in line.
The stock is actually popping all-time highs here this morning, so there's been a ton of resistance. And I mean, I just look at this chart and it just jumps out at you when you go out to the weeklies. You can see all those highs just under 105. Every time this up gets into the 104s, it struggles. We are over that area right now. We just kissed up to 108, so that's a big level. Just a little bit word of caution, though, because we aren't above there on a lot of volume. It's only 6,900 shares. So let's see if we can take out that 105. You take out that 105 in the regular session, then, you know, it opens right up. So that's, you know, and you know, it's some of these things are difficult to fade too. We saw some of these earnings reports, you do the gap and go. So just because it gaps up doesn't necessarily mean it's going to fade, even when it's on a bad day. Some of these things have had gaps and goes. But 105, I would be concerned. If it gets back down below 105 and can't take that out, then it could give some back. But as long as it can stay above 105 and open above 105, then it's got room to run.
Also, they're spinning off their dental business into an independent, publicly traded company in the second half
so that helps too.
Of next year.
People like spinoffs. Investors like spinoffs.
Why is that?
I looked at the book. There's not much there. 9,700 shares and 105. But still, I'm going to say technically it's just a big level.
All right, let's move on to, let's go to eBay. They reported yesterday after the bell. 53 cents was the Q2 EPS, which was a 2 cent beat on the estimate. Sales $2.64 versus $2.66 billion. So a slight miss on that. The Q3 EPS guidance came in light in line. 54 to 56 cents was the estimate that they gave, or the guidance they gave. 56 cents was the estimate. The sales guidance for Q3 came in a little bit light. The fiscal year EPS guidance was higher, actually, and the fiscal year sales guidance was light. So to summarize, they mixed on the Q2 numbers and mixed on the fiscal year and Q3 guidance.
And I look at this here, and this chart after hours gave you a shot. It got killed on the initial numbers, and then it popped all the way back and actually went green and up over 38 bucks. And then the leak just started, and the leak never has stopped since. So we are still leaking here in the pre-market trading right near the after hours and pre-market lows here. So it's ugly here now, eBay, but you had a shot. Sometimes they do give you a shot. If you don't like the initial numbers, sometimes there's a whipsaw down, and sometimes they give you a little rally back up. That was your out. Now it's looking ugly. Now it's breaking down through all these levels. This is not a good looking chart. I mean, the one good thing is, you know, BTFD mentality here. You know, it is eBay. There is a low at 33.94, so I'm probably not coming here and shorting it down 3 points just because I've saw, you know, stocks, you know, it seems like on the tech stocks that they do eventually come back. So I think when I look at this 3 months, it's probably higher, but right now completely out of favor. I will say you do have some good support down $34. So I'm not totally, I got to go and sit and do the valuation on this. How much did they make this quarter?
Oh, let me pull that number back up.
Give me the numbers.
They made 53 cents.
So if you say $2, $2.50, you know, sometimes let me just go look at the PE, what it actually is right now going forward. Do you have that information in front of you?
I can
before I go bother looking it up.
Pull it up. Let's see if I have it in front of me. No, I have to go get it real fast.
Anyway, so I don't know, if you just round $2.50, maybe they make this year, just guessing because they made 53 cents this quarter. Yeah, it's sitting with a P of 15, 16 for. That's not that bad. So I think you might find some bias down at that 34 area. So I don't think it's going to be a whoosh down like 32 or 31 or 30. I think, you know, a lot of the selling, even though it's under a lot of pressure here right now, I think it could find support. We found support 34.09 back in August 2017, and he found it again in December 2017, 33.94. I think you bounce at the 34 level if I'm trying to call a bottom, which is dangerous game.
Let's go to American Express. These payment stocks have just been ripping the past year or so. This has been sort of the exception to the rule. Hasn't been as strong as its peers, Visa, MasterCard, and Square. Looking at the Q2 EPS, $1.84 is a 2-cent beat on the estimate. Sales $10 billion versus a $10.06 billion, so a slight miss on that number, but as far as I'm concerned, pretty much in line there. They reaffirmed their EPS guidance for the fiscal year at the high end of the range, which is $6.90 to $7.30. They said they're going to be at the high end of that range.
This is a tricky chart here. So you had a stock that was trying to break out to all-time highs, disappoints, comes back in, but you got all kinds of trading, that we've had in the last couple of months between 95 and 90 or 96 and $100. The real support comes in at $96. I don't know if you get that low there, but I think if you got down to that level, I think that's where it could potentially bounce. Again, I'm cautious of selling anything that is significantly down simply because this buy the dip mentality comes in here, and it's a stock that was at all-time highs. I think you find buyers $96, $97 if you get down there. Not sure you get there.
All right, moving on to Alcoa AA. I thought they were the unofficial start of earnings season. I guess those days
not
are over.
Anymore.
Not anymore. Q2 EPS for Alcoa, $1.52 versus a $1.35 estimate. Sales $3.6 versus $3.44 billion. So nice beats for both numbers for Alcoa. The fiscal year sales guidance that they gave was good as well. And let's see where we're at.
Still got in my long-term investment portfolio. It's a small one. It's been a dog forever. Bought this way back in the early 2000s. It did spin me off Arconic and Alcoa, so I have two stocks out of it. But when I add them together, I'm still not at my initial cost basis. I don't know. It's it's showed some life back in April. Probably should have sold it back then when it went from 45 up to over $60. It's come all the way back down. Yeah, major support down there, 43 to 44. At 46.66, again, you're kind of in the middle of nowhere. Tricky charts and tricky market here too now. I mean, you just look at this overall. You're selling off a little bit here, but we've had a pretty good run. S&Ps, I still think are going to be, I still think you got to be buying pullbacks. So I still think we're going to be making new all-time highs. I once said by the end of the summer, and I think I even said maybe by the end of July once. I don't know if we're going to hit by the end of July, but I think by the end of the summer, we're hitting new all-time highs. It would be 286 on the SPY. So I'm still a buyer of pullbacks here, but none of these stock charts that you just showed, American Express's, Alcoa's, look great to me. You're getting pullbacks. These are trading down. Maybe these are the ones that get bought, but these are not your market leaders.
Let's go to some of the earnings reports from this morning. We have time for about one more before we go to our first guest or our only guest today. Let's go to Philip Morris. PM reported this morning Q2 EPS of $1.41 versus $1.24 estimate. So a nice beat on that. Sales $7.7 billion versus $7.57 billion. So beats on the top and the bottom line for the Q2 for Philip Morris, but they cut their fiscal year EPS guidance by 6 cents on the low end of the range from $5.15 to $5.09. The range itself was in line with the estimate, but cutting that guidance is probably the reason for that weakness this morning.
I think consumer staples have topped out. So I'm just going to say I think all rallies to be sold now in consumer staples. If you look at the XLP, we've had a nice run from the lows in May from 49 up to 53. That's a big run. You saw it in Procter & Gamble going from the 70 basically up to the 80. You saw CLX, they got hit with a rating again. So Goldman downgrading them to sell yesterday. Today you got UBS putting a sell on them. Philip Morris fits right in with it's a big chunk of the XLP. It's trading down here, $78.71. So it's having an ugly day here too. Off their earnings, out of favor here. Now had a little comeback from June, but these stocks, especially Philip Morris and MO, they've been out of favor here for a while, and I think they continue to remain out of favor. So I think I'm a seller of all rallies in Philip Morris, and I'm a seller of all rallies in staples here now. That includes Coca-Cola too. Coke's had a pretty good run here. I think it's 41.50 to 45 is a good run for Coke. So I don't know. I just look at this XLP chart. I think we topped out. So, and I'm also going to say I think we topped out. I think we're going to top out in the utilities here too. I said that a couple of weeks ago. We whooshed down. I think XLU is giving you another chance because it came back a lot. I think I'm a seller of utilities and consumer staples. I think if we're going to make new all-time highs, these are not the stocks that I want to own for trades.
All right, A15, we're going to grab Gil Morales. He's the author of the Gilmo Report and the managing director at Mocha Investors. We'll be right back in a moment with Gil. All right, welcome back, everyone. Spencer Israel, Dennis Dick here on Pre-Market Prep, now joined by Gil Morales. He is the author of the Gilmo Report, GilmoReport.com, and the managing director at Mocha Investors. Gil, how's it going this morning?
Good. How you doing, Dennis?
We're doing well, doing well. I know Dennis is in the background, and
I'm sorry.
No, it's all good. It's all good. You know what? I'll give you a pass.
I'm here too.
I'll give you a pass because it's 5 a.m. where you are, and so it's very early.
5:15 to be exact.
All right.
But I've been up for about 45 minutes, so that's fine.
So, do you get up that early just because, for the market prep, or
I actually get up earlier than that, but I have to make myself go back to sleep, just because I'm so excited for the trading day.
So no, I'm wondering what your morning routine kind of looks like then, as far as the markets are concerned. If you're up at 4 a.m., like, are you trading?
First I get up, then I usually wash my face, comb my hair, have some tea and oatmeal, and then fire up my computers and just start looking at stuff. So I just start cruising around and looking at things and checking opening prices of various stocks I'm interested in. Like this morning, I'm noticing UNP. I think it's trading down. And yesterday we had CSX gapping up, so I don't know if that's going to have a mitigating effect on the group. The rails have been basing, and it looked like CSX yesterday's breaking out. So this morning, I think UNP, Union Pacific, I believe, let me check that again, is trading down about $5-6. So, it's a bit of a mixed bag, earnings roulette. So I'm always interested to see what sorts of opportunities arise as a result of earnings reports. I don't like to hold stocks through earnings reports unless I have a big profit cushion one way or the other. And yesterday, for example, you could have bought CSX in the morning at around 66.60, somewhere in there, put in a low at 66.30, and then it continued higher to 69. That's a buyable gap up setup that I'll use. This morning, we've got a gap down in UMP. I don't know if that becomes a shortable gap down, but we'll find out. The other option is that you get a gap down move that turns into a tradable buy, long setup. That's what happened to Netflix on Tuesday morning. And so you have to be alert to all of these. And I think that's mainly the opportunities I'm looking for during earnings season. And in this environment, I still think we're in a swing trading environment. I don't think you're in a strong trending environment. I know, stocks like Amazon, Facebook, you've even got Microsoft, Google, they're continuing to make new highs, but they move very slowly. And you'll find that the biggest moves you'll have, in other words, high time value trades where you're spending the least amount of time watching the position while it generates a profit, they come in these things coming off the lows. For example, you look at a stock like Huya, H-U-Y-A, that was a hot IPO. And that actually issued what I refer to as an undercut and rally buy signal at around $30. Let me check this, I think a couple of weeks ago, may have been about 8 days ago. And so that $30, that was your entry point right there. And you got to 40 yesterday and the day before. So what is that right there? That's about a 30 something percent, 33% gain in about 7 days. And so that's a high time value trade. And that sort of setup where you undercut a prior low in a pattern is basically derived from Wyckoff Spring, if you're familiar with Richard D. Wyckoff's writings. He was a guy who first interviewed Jesse Livermore and wrote about him in I believe it's called the Magazine of Wall Street. So, so what you do is you get now you get these moves. You look at another one, Z-Scaler, Zoro Sam, ZS, and that one had a buy signal based on the Wyckoff Spring / undercut and rally, or UNR setup back on June 28th at around 35.5, 35, and now we're sitting at 41. So you've gotten a pretty decent move there, not quite 20% in about 2.5 weeks, and so that's high time value. But see, now these things are back up near their prior highs, so back up to the top of their bases. So in my view, that sets up the potential for a pullback phase in the market, or at least some backing and filling. I mean, we could top too, because everything looks so darn good, So that's kind of what I'm looking at right now. And basically, I came in short the market overnight. I'll go long the SQQQ and the UVXY. Those are the vehicles I play when I think we're reaching an extended point, looking for a pullback. And I may trade the pullback temporarily or try and hold it for a longer move like we had back. When was the last time we had a good break? Back in late June. So where you get a few days of downside. We might get that here. We'll see. But I'm pretty strict in my discipline in terms of trading these things. I use a 5-minute chart to trade them and initiate positions and bail out if the market turns. But that's basically what I'm up to in this environment. I don't see big trends developing from breakouts. And I think these days only fools buy breakouts. I think the better setups come off the lows of patterns.
There's a lot there I want to follow up on. Dennis has also been watching HUYA, I know. But so what? Let's start with this. What gets you interested in a stock? What kind of patterns are you looking for?
Well, I'm looking for things that might have a strong thematic basis. So, for example, what gets me excited about a stock like Huya is, number one, it's a hot IPO. It had a big move, and then it had a big breakdown. And usually what happens when you see something have a huge breakdown like that after a big rocket move to the upside is a lot of people see that and they miss it. And if it starts percolating again up the right side of, say, a big sort of cup-shaped formation, the speculative fever will come back into it very quickly. And usually it's driven by some sort of thematic rationale. In this case, I think the whole video game thing, Huya is a platform for video games. Another one is Bilibili. These are Chinese names. And I think they're...
We talk about them all the time.
Pardon me?
We talk about these guys all the time.
These are like go-to.
I throw in names like here. I don't know the name of the company. Turtle Beach Corporation. Yeah, they make these hotshot video game headsets. So my son is a video game nut, and he told me to buy, Take-Two, Electronic Arts, and Activision, about 100 points ago. So this is another one he's been on to, and the pattern's been there, and that's a little more steady. But getting back to the Huya and also the Bilibili, so I think the whole video game thing is still a big thematic driver. As a form of entertainment, it's relatively cheap. And now there's this sort of esports movement where they're starting to create. If I read the article correct, it looks like professional teams of video game players, right? So it's taking off. So there's a lot of excitement. It's a little bit like Bitcoin was at the end of last year. Everybody's suddenly excited, and so I look for an undercut of a prior low in the pattern as it's rounding out either a sort of a cup formation or a saucer formation. So if you look at the chart of Huya, you can see that actually occurring back in late June. And what happens is you'll set a low and you'll bounce a little bit off it. So it set a low at around 30, and then it bounced up off of there. And then you undercut the low. And as you came down to the second low, you can actually see the selling volume dries up. And then it picks up for a couple of days, but the stock doesn't have any further downside progress. The next day, you turn back up through the 30 price level, which is where the prior low is. That would be the low on June 28th, which was actually 29.75. So you come up to that low. The instant you come up to that low, that's your buy signal. And I'll come in right there and use that as my stop. Now, if it pulls back, 50 cents, then I'll get stopped out. But I'm also willing to come right back into it and take the position back again. The idea is I'm looking for a good snap move. And Wyckoff referred to this as a spring formation, and for good reason, because you do get a nice springy type of move off of it. And you can look at, a number of stocks had this exact type of setup. Look at a stock like Box, for instance, Box Inc. Mm-hmm. Probably that's like a, like Acme from Wile E. Coyote and the Roadrunner, Box Inc. How generic could you be? But you can see that thing is breaking down on June 27th. It looks ugly as sin, but it's undercutting a low from May 31st, if you look at the pattern. And from there, it turns right around. I mean, this thing looks like, by all rights, it should head straight for the 200-day line down around $22 at that point. It's somewhere around 24.25. But it undercuts that prior low, fakes everyone out, and then just starts marching back to the upside. And now you've gone from around 24 and change up close to 28. And on on Tuesday, it had a pocket pivot, pulled into the 50-day yesterday. So it's still actually in a buyable position. Although the best spot to buy it was just above 24. But again, you get a nice move of about, I'm going to say, 15% or so, maybe not quite 20, but about 15% in just a couple of weeks. And, these days, if you buy a breakout and you get 5 or 10% out of it, I think you're pretty lucky. So, that's pretty much the type of setup I'm looking for now. And the clouds, Box is a cloud name. So those have all been pretty hot, and that's been continue to be a hot area. I think the buyout of Computer Associates by Broadcom, which is Avago, and don't ask me why, they screw me up all the time because they call themselves Broadcom, but they're using Avago's symbol after the.
Why do they change their names? Why do these companies change their names?
Well, they didn't. They actually, Broadcom merged with Avago, and so what they did is they kept Avago's symbol, but it makes no sense because I think of Broadcom as BRCM. So every time I'm thinking of the stock, I want to type in BRCM for the symbol, and instead it's it's AVGO. You know?
I hate it when they change the symbols.
Yeah, and I don't know why they're doing whatever. I don't know. I'm not into corporate politics. Whatever it is, what it is. But I think that whole thing got all the softwares sparked. And so you saw names like the Trade Desk, Twilio, Workday, ServiceNow. Right. In fact, if you look at Workday, here's another one of these undercut and rally setups where you had set a low of 120, looks like 121.68 on June 11th. Okay, and then on June 27th, you bust the 200-day line, and it looks like this thing's just going down the toilet. And then right there it finds support. It turns back up. 2 days later, it bounces up through that low at 121.68, and that's the low, and just keeps going. And now we're at 136. So what's the move there that you're getting out of there? Pretty quick 10% move in about 8 trading days. So now it looks like it may want to break out. So those go ahead.
I just want to ask you in general, because certain technical patterns work at certain different times, and all these setups are similar. Like you're going after, breaching the lows and then coming back up over it. And sometimes, like you said, sometimes breakouts are just flat out working too. Maybe not right now. That's not the case.
Trending market. Yeah.
That's what I was going to say. How do you identify like when, to strike on certain trading patterns?
Well, I mean, it's pretty much just an objective sort of thing. It's does it work or doesn't it? What works and what doesn't work? And so you beat your head against a brick wall for a few times, and you begin to realize, oh, wait a minute, this is a brick wall, and you beat your head through a sheet of paper, and you realize, okay, this is working. So it's more or less that sort of process, trial and error. And so I'm just poking around all the time and getting a sense of what's working and what's not working. Yep. And in this manner, I can strike on some pretty strong themes. And this undercut and rally theme has been working like a charm for, I'm going to say, about the last year. Because you look at the market, it's just chop one way, chop the other way. When it starts to look as ugly as it can possibly look, it just turns around. And that's a QE market. To me, it's all driven by QE, not the magnificent Trump economy. I think that's a bunch of baloney. And that's what happens. You get down there far enough, boom, somebody flips the switch on the algos, and it's, buy. So
I feel like I just went to technical analysis school. So that was great.
For 2018, it may change, and check back 6 months. It may change, and we may get back to a trending market. But I tend to think that we're going to have to go through a massive washout to clean everything up, because the system is so distorted by all of this QE. And it's just ridiculous how the Fed head Jerome Powell gets up there and talks about the Fed's mandates of full unemployment and price stability. And I'm thinking to myself, well, what about propping up markets and failed financial institutions? You forgot to mention that mandate. That's the silent mandate, and that's their primary mandate right now. Because if the economy's booming so well, why are interest rates still 1.5%? That to me, that's sort of obvious and in your face. It's like somebody telling you it's raining, but there's a downpour, coming down on you, and you're getting very wet.
Yeah, we could probably wonder about that all morning, but I'm going to let you go.
Oh, yeah.
Gil Morales, he's the author of the Gilmo Report, managing director at Moka Investors, MOKA. Gil, wonderful interview. Thanks so much for the time, and have a good rest of your day.
Okay, you too. Take care.
All right. Wow, that was tremendous, Dennis.
Yeah, I mean, from technical analysis, Gil is, as good as you're going to get. I mean, he's identifying different patterns, and such a great point he's making, and like I was trying to make with it too. It's like at certain times and in certain markets, there's going to be patterns that are working, and he's just doing trial and error. That is exactly how I trade as well. I'm doing trial and error, not only just on technical analysis, but on different stuff. And on certain times, certain things are working, and I'm always, me, if you've been listening to the show for a while, I'm more of a relationship-based trader. So I try to identify these new relationships and try to get cues from, where they're going. Like that HUYA, it's funny, we're both trading the same thing, but we're trading it for different reasons. And I was looking at that one more as my leader to trade IQ, to trade SOGO, to trade BILI, although AILI hasn't participated there. But I mean, that's how I trade too. But that pattern that he's talking about, you just think about why that works. And I'm a big on the market psychology. Why does that work? Because you're getting down. People are all leaning on a low from before, and when it breaches that low, they stop out. So you get all these day traders that have been trying to call the bottom on the thing, and they're trying to call, and they wash out. So now all the short-term traders have sold. Now it gets back up over it. And now you get, people like Gail who are astute are going to come in, and start to buy it. And then it starts to run a little bit. And then the trader who just sold it down there is like, oh my goodness, I sold at the low. They're coming in and rebuying it as well. So then they push it higher too. So, that's kind of the mentality behind the trade. And, that's how I try to always think. I try to get in the market's head. What is the market thinking? And, why is this working right now? And in certain environments, certain trades just work. Classic breakout trades work in a trending market. If you're going up, and it's breaking out, it works. But, this hasn't been the market, in the last year that we've been trending higher. Really, when you look at the S&Ps in 2018, we have just been shopping around like crazy. Like, go and look at the chart of SPY. We started the year up, around the ties, 286, all the way down to 265. Then we run up to 280. Then we come down to 255. Then we run up to 280. Then we're down to 270. Now we're back up here at 280 again. So if you're just buying classic breakouts here, you're probably buying the tops all the time. So it's tricky. So, he's kind of, changed, for the environment that he's in, and actually buying, breaches of lows and then coming back up, playing the contrarian strategy and getting on the train early. So, so here you can look at the market the same thing. It looks like we're going higher. I think we are going higher eventually, but it's not going to be a smooth ride. This market in 2018 has been anything but smooth.
All right, 8:33 now. I actually, while Gil was on, I booked us a guest for 8:35.
Look at you. The back someone just working.
So yeah, well, he was like a self interview, so I was free to do my own thing. But
Gil's awesome.
Yeah, this was someone I reached out to last night, David Miller. He's the senior portfolio manager and CIO at Catalyst Funds. So I'll get David on in a minute, a couple minutes. But before we do that, let's get some imbalances.
Go take a look. I haven't even looked myself yet here. Is there anything jump out at us today? They have been small for a long time. 105,000 is sell. Just cannot get life here, even though the market was showing life. It just kind of meanders there. I feel like it's waiting for the next, headline to really drive it higher or lower. You know what it needs? You have not seen an analyst rating on GE in a long time. Like an analyst come out and get bullish or bearish, and it doesn't know where it wants to go. Part of it, the value investors are saying we want to own it down here in the 13s, and the growth investors are saying we don't want any part of this thing because it's a mess. And then you've got also value investors, some of them saying there's just too much debt, like me, saying there's concerns there. So here's bullish and there's bearish, and that's why really in 2018 we've kind of gone nowhere too. This could be almost like a story stock for 2018 because if we just look back out to the weeklies on GE, it's kind of the same thing. We started the year up high. But, by April, we were at the lows, and then we rallied, in May, June, July, and we sold straight off, and then we tried to rally a little bit here again. So it's just chopping everybody up there, too. It has no real pattern, no real anything here right now. So difficult trade. I mean, you can say it's kind of forming a pennant here. Eventually, it's going to break out one way or another. But what it needs is somebody to give it a vote of confidence if it's going to go higher, or to somebody say, hey, we think that you got to get out. This thing's going to single digits, and then it's going to go lower. So I'm waiting for the next analyst commentary really to dictate, or the next fundamental information coming from GE to dictate that next direction.
I guess you're talking about like big influential analysts. They did get initiated a buy at Gabelli back in May.
Yeah, that's not good. And now it's May. Okay. That's 2 months ago. You think about like a stock like Square, you had an analyst report every other day. Well, they got target change or something.
They got upgraded by.
There's no interest here.
Upgraded by Oppenheimer June 27th to neutral to perform. But yeah, I guess you're right. Nothing.
They've been very quiet. It needs something. It needs a catalyst to get us out of this, just kind of shopping around. Shop fast.
8:35. We're going to take our second break of the day and grab David Miller, CIO Catalyst Funds. We'll be right back in a moment. Welcome back, everyone. Spencer Israel, Dennis Dick, now joined by David Miller, Senior Portfolio Manager and CIO at Catalyst Funds. David, how's it going this morning?
Great. Good to be here.
So I booked you on this show this morning, and I had no idea that you went to college with Jason Resnick, our CEO. Is that true?
Not fully true. I went to high school
with
Jason
him.
Resnick, and we both did go to Michigan, but at different times.
Okay, you went to high school with Jason Resnick. I swear I didn't know this before 10 seconds ago. What'd you guys were you guys like, buying the .com stocks, during the bubble? Like what was he like back in high school?
He was a great pizza cook at Pizza Hut.
Look at Jason Resnick. The pizza. He makes good pizza.
Oh my god.
He got it.
Great pizza.
That's a great story here. This is good background. Is Jason listening right now?
I don't
get him over
no,
here.
He delivers them too.
He's not listening, because if he was, he would have run over right now. He run over to my desk.
This he denies it's not true.
Wow.
Make us all pizza now.
That's great. Anyway, let's get over to the markets. Today, I guess, would be one of the first big earnings news crushes of the season. What is your routine or style during earnings season, or how do you approach just like the crush of earnings every day?
So the way that we approach earnings is a bit different in the sense that we're not directly trying to anticipate what the earnings of a company are going to be, but rather that the top executive for us who are running the firm on a day-to-day basis should have a pretty good feel for that. So I run the Catalyst Insider Buying Fund, where our methodology is to track the buying and selling of those top executives to see from what they're doing with their own money, what their belief is as to the direction of that company. So we're buying companies that have heavy insider buying and or selling out of those where the insiders are selling their own stock.
Is there some sort of a lockup period around earnings for insiders?
So there certainly is a lockup period around the earnings period where the top executives are blacked out from trading. But that certainly doesn't mean that, prior to that blackout period, that the top executives don't have a relatively good feel for what's going on at their company and, where things are more likely than not to be going later on when they will be announcing earnings. So
the general strategy is just sort of tracking companies where executives are buying shares or where executives are selling shares. I'm sure you're not just buying and selling based on what companies have the most insider buys, or maybe you are. I don't know.
Well, that certainly is one component to it, but it's definitely not everything. We've also found that there's this concept called post-earnings announcement drift, where you find that companies that after they beat earnings or miss by that same token, if they beat, they're more likely to continue to outperform following that earnings beat, and the stock's more likely to underperform following a miss. And secondarily, that companies that have a history of beat earnings are more likely to continue beating earnings, and companies that miss have a higher likelihood of continuing to miss. So in some respect, we're using the history of their earnings performance relative to expectations to gauge which companies we want to be involved with.
Over what horizon is that?
So typically in terms of the earnings horizon, we're looking at their past 3 years of earnings history. And then we're also comparing that with the performance of those particular top executives in terms of the timing of their buys and sells historically. So, if a particular CEO or CFO had been getting it right very frequently, that's going to get a higher ranking in our insider score that we use than a company where the top executive had been timing their purchases or sales poorly historically. So it's really using a ranking based on both the insider activity of the company, the price momentum of the stock, and that earnings history of the company relative to expectations.
Can you give us some companies that have had some notable insider buys or sales recently, or a lot of activity in that area?
Yeah, absolutely. So one stock where we've been impressed with their earnings history is Home Depot. That company has had some relatively good insider buys by their top executives at Home Depot, notably Stephanie Lenartz, a director at the company, just bought pretty recently. Gregory Brenneman, a director, had bought a couple months ago. Armando Codina, another director, bought fairly recently. So that's certainly a good example with Home Depot. Another good example where we've seen some of that type of activity would be like with Adobe. Adobe has had a tremendous history in terms of their earnings track record of rapidly growing their earnings revenue and beating expectations. And then when you time that alongside one of the purchases by Amy Vance, director at that company, who had a relatively good track record of her purchases, buying in a meaningful way back in December of last year when the stock was back at 177, that led to some pretty strong performance in the stock thereafter, where now Adobe's trading nearly $260 a share. So certainly her insider buying signal was a good one to watch.
So insider buying is obviously, one signal people use of many. What sort of attracted you to insider buying? Why do you put a lot of stock in this particular signal?
Sure. So there's a professor that I studied under when I was doing my MBA at the University of Michigan. Professor's name is Nejat Sehun, and he's a world-renowned expert in insider trading activity. He actually wrote a book called Investment Intelligence from Insider Trading that detailed a number of studies that he'd done over the past few decades to find the alpha that was associated with purchases and sales by top executives. And as I learned about his research, it seemed like a natural thing that should be put in more focus rather than, typically where analysts are just using their external experience and whatever they can get from reading about a company or talking to people to make decisions. It seemed much more intuitive that you'd want to follow the people who are actually running the business on a day-to-day basis.
I'm wondering if there are specific events that sort of catalyze a lot of insider buying or selling that you've observed, maybe besides earnings.
Sure. Well, aside from earnings, one that, in terms of insider selling, it's tricky because you need to make sure you're watching it carefully as to the information that you can gather from the signal. Because the thing that will correlate the most strongly with insider selling is a stock that just did very well historically. And if the stock's up dramatically and the top executives have made a lot of money, naturally there's going to be an inclination to cash in some of their chips. But that signal doesn't really mean a whole lot if it's because the company did well. Where we found it has real meaning is, if the company's missed earnings, things have been going poorly at that company, the stock's down significantly, and rather than buying into that cheaper price, you'd see the C-suite executives dumping their stock heavily after that. That's a really good signal that that's a company you want to stay far, far away from. By the same token, if you see that the executives have been buying heavily into a stock price that's rising as opposed to one that's declined, and there's been a lot of good news, and rather than cashing in their chips, they're buying more, that's where you really want to get involved. So there's a natural inclination by executives to buy when the stock's cheap and to sell when it's expensive. But when you see that they're doing the opposite in a big way and they've had a good track record with those transactions historically, that's really where you get the best signals.
I'd be remiss not to ask you about the news from yesterday morning where Berkshire announced that they're going to make it easier for them to buy back their own stock, and a lot was made of that just because it's Warren Buffett and people like to follow what he does. Is that a common thing to do to sort of ease restrictions, and kind of what was your take on that?
Well, I guess there's two aspects to that. From one perspective, buying back stock is an extremely common thing to do across companies in the S&P 500, and you have over $1 trillion in buybacks this year, especially with the tax cuts. But for Buffett, it certainly is not typical that he would be buying back his stock in a meaningful way. Last time I believe he did that was back in 2012. And when he did, historically, there was kind of a metric that it would be because the company was trading at less than 1.2x book value. Clearly, Buffett hasn't found any of the real companies that he thinks are those monsters that he can acquire that can make a big difference to his company's business. When he typically goes whale hunting, he's trying to find really meaningful acquisitions. And in this case, it's a clear indication that he believes that Berkshire is undervalued relative to the other companies that he's taken a look at to consider acquiring. And they have over $100 billion of cash. So it's a good way to deploy a lot of cash effectively.
Does that indicate to you a lot of people took that to believe that he was going to buy back more stock? Does that indicate to you that he will, or is it just like a formality? Is this just a, just preface?
Well, to your point, we found frequently it actually just is a formality. Companies will authorize buybacks that are much larger than what they'll actually do in practice. With Berkshire and Buffett in particular, he has a real track record of sticking to his word. So I think it's a pretty good indication here that he's actually likely to follow through with a pretty big buyback at Berkshire.
All right. David Miller has been on with us. He's a senior portfolio manager and CIO at Catalyst Funds. He's also a Jason Raznick historian. David Miller, thank you so much for your time today. Really appreciate it.
Been great to be on.
All right. 8:49 now, Dennis. Where are we at in the market? Anything interesting happening out there? Dennis, are you with me?
Yeah, I am with you.
With
I don't know.
Okay.
I actually unmuted, but I guess I double clicked it, so I remuted myself.
That's
So pulled to Joel, had to do it for him. So give a shout out to Joel there as he's on his vacation up in northern Michigan. Jump over to Tesla. We have news. Needham downgrading the stock here to underperform. Stock trading down 7 points here in the pre-market there. Do you have did you get a chance to look at this note at all, Spencer? I'm not sure.
Nope.
Do you have any details or a price target? But underperform, obviously, equivalent of Needham sell. So they're coming out here using the strength from the last couple of days to sell the stock. It's down 7.
Only thing I see is the cited increasing Model 3 cancellations. So
I am so torn on Tesla. I mean, and this is just, indicative of the environment and a lot of stocks that we've seen. This has just been a chop fest here too. We had the big rally up from 280 up to 370. And then, we sold off and then we came back up to retest. And then obviously, after they hit those production numbers, we sold off heavy there, washed out everybody under 300. It has not come back down under 300 since I actually took the long trade after the under 300 washout because that was almost like a Gil Morales setup. You get down there, you wash everybody out, you get above it, and you trade off of that level. But now I look at it, and you're kind of in the middle of nowhere here. So I'd say as long as if you are sticking with the bull theme, you absolutely need to hold that 296 low that we made back on July the 5th. That's 20 points away from here, so that's going to help you with today's trading. I don't think there's any setup here for today. I mean, it's just, again, maybe it's the buy the dip mentality. Maybe it's giving me another chance to get in. It's still obviously higher short interest here in Tesla. So I think the path of least resistance probably still remains higher, but you got to hold that low of the 296, and I just don't see a trade set up here at 316 because if I'm going to come in here for a long entry, I have to give it to 296. That's 20 points. I don't like giving it that much. I think the lower 300s, maybe is, better if you're going to give it the 296. But if you're willing to give it 20 points, I mean, I guess you could take a shot on the long side, but I think you got to give it that 20 points, and that's a lot to give.
All right. Before we get to the ratings, let's talk about this Cisco news. There is a report that Amazon is getting into the switches business. That looks to be not true now. So it looks like a
headline-driven market, and that Cisco sell-off, can I just say, was absolutely ridiculous. So, it's just rumors, Amazon rumors coming out, the Death Star, as Kramer calls it, was coming out there 4 days ago, and there was a report that they might start selling the switches that Cisco and Juniper makes. Cisco gets absolutely annihilated on that report, goes from 43.78. Within 20 minutes, it's down $3. And, this is a stock that typically moves $3 in 3 months. So this was a huge move. It's one of the biggest moves it's ever had in the last year. So from 43.78 all the way down to 40.94. It bounced that day, and it kind of meandered since. So comes out a report last night from Market Watch, I believe. I saw a report at first that no, this is not true. Amazon will not be selling the Cisco switches. And Cisco just blasts off into orbit, gets all the way back up to almost $44. A just ridiculous move here again. It's sold off now, and it's come back down to 42.66, but just shows you how much the headlines drive stocks. And it was a vicious rally last night because I was like, what is the news here? I saw Cisco on 42.20, 42.30, 42.40. I was like, what's the news? I'm scrambling around. And then, I saw it there. I actually saw it on Twitter first, where they saw the Market Watch article. I was like, I'm like, well, it sold off a couple bucks on that. I guess it can rally a couple bucks on it, but it kind of had rallied some of it back. So I think, up in the 43s, 44s, there's just technical resistance up there. That's right where it got to, and it sold kind of back off here this morning. But that's the headline here. Juniper, same story to a certain extent, although muted activity. Juniper sold off only about $1 on it, and then it was rallying a little bit last night on this report. It's come back down now. Overall market dragging it down a bit here too. But the real move was in Cisco, and all headline driven.
Do you think Wendy's is going to buy Papa John's? That's the rumor.
No. No, and Papa John's is trading down here in the pre-market there, obviously off of the Domino's Pizza report. So, and we haven't talked about Domino's Pizza here yet. Here's a stock that was priced for perfection pretty much going into the report. What were the numbers for Domino's Pizza? Let's go back to that.
Sure.
DPZ. Bro.
Yeah, DPZ Q2 EPS $1.84 versus $1.75 estimate. Sales $779 versus $783 million. So
sales were light.
Miss on the sales, but it beat on the EPS. So it's mixed and all. I'm not liking it though.
The stock is up 100 points in 2018. I mean, it started the year down there at $186 and got up to $289 or $293. Last night was trading $287. I mean, it was priced for perfection. The stock, even though it consolidated here in the last month, really, when you put the run in perspective, it's been an incredible move again here for Domino's Pizza. And I must say, I still say it, I think Domino's Pizza is the best fast food pizza. They get some local establishments that are really good, but out of the big chains, if you're always safe to go with Domino's. I like Domino's Pizza.
I'll buy that. As far as fast food goes, I'll buy that.
Yeah, like fast, chain pizza. I think Domino's Pizza is the best one. And bang for the buck, it's cheap too. So, so I'm a fan of the product. The stock valuation has always scared me away. I wish I would have. I thought about buying it back when it was pulling back, and how I like to buy my pullbacks, contrarian investor, back, at 180, 190. I never pulled the trigger. Wish I would have, because of obviously we ran 100 points since then. So we're selling off here this morning, probably because, this is just price for perfection. It's come back off the lows already, though, in the pre-market. So buy the dippers already coming in here to Domino's Pizza. I saw this down the 260s. What's the pre-market low, Spencer? Can you just bring that chart back up? Because I think we're significantly off the lows.
Pre-market low on Domino's this morning is, what is that, 266, I think?
Yeah, so we're $5-6 off the lows here now. So, we are in a little bit of rally mode. The buy the dippers coming in here. I'm not making a trade on it at this point in time. I mean, you get up to your 280, probably got people who are willing to sell it that probably got caught, but you're kind of in the middle of nowhere here. Could it continue to leak? Yeah, it could, but it wasn't that bad of a report. So I tend to think that they're going to buy the dip more than they're going to sell the rip on this thing. So anyways, that's my story on Domino's Pizza. I like the product. Not sure I got a trade here on the stock way, though.
But then bring it back to Papa John's. So down, clear sympathy play this morning?
Yeah, that's just pure sympathy. So, there was a rumor yesterday that, Wendy's, when the CEO was there, had sniffed around potentially, going to buy Papa John's. I don't think that's going to happen, and this was an old rumor there. So it's down just in sympathy here this morning. But, I guess, you could say potentially in play. But, Papa John's chart, $50, been great support down there. So as it gets close to 50, you find buyers. But again, comparing it to this Domino's chart, I mean, wow, two stocks going the opposite direction, $90 down to 50. We talked about this the other day. You did have that washout low, so this does set up, kind of like Gil Morales was talking back on July 11th when he got down to 47.80. I don't know what the headline there was, but that was the washout. It got right back up over and then had a vicious spike. Then he came back down to tests, and the 50 was your buy signal. That was the old support level that held. So now you're kind of 53. Now you almost got to give it under 50. So it gets a little bit tricky here now.
July 11th was Papa John resigning from the board. That was.
So I got him out. So obviously not all the
all right.
Stuff going on.
3 minutes left. Let's get to some ratings real fast. Big note this morning from UBS on the Staples. Consumer Staples, not Staples the company. I'll just run through mostly just initiations, but there was 2 upgrades, upgrading GWW to neutral, upgrading CL Colgate to a buy, and the loan downgrade was Procter & Gamble to neutral. Everything else was initiated or maintaining something and just raising or lowering a price target.
Procter & Gamble's ex-dividend today, so you got to do the adjustment. It paid a 72-cent dividend, so the adjusted close is 79. So Procter & Gamble's actually only down 60 cents on this, which is not that much. The CLX got ganged up on the last couple of days. Goldman downgraded to sell yesterday. Now you have UBS coming in, putting a sell rating on it too. So boom, basically in 2 days, you lose like $8-9 here. I think you're going to bounce around that 125, 126 area if you're on Clorox. But again, I think bounces are all to be sold in the consumer staples. I think they've topped out. Just my opinion, but I think XLP, if I'm looking at that, it's very weak this morning. Got a lot of stocks putting pressure on the XLP. Obviously, Philip Morris being one of the main ones because it's trading down $5 here now, but also Clorox is trading down, and some of the consumer staples. Other stocks are trading down as well, like Procter & Gamble. So I think if I'm looking here, I just think rallies to be sold in all the consumer staple stocks, and I don't want any of these in my portfolio here right now. We've had a pretty good run from the lows there on the XLP and a lot of its components there. And I think that run is stalling out, and I think it's over for the short term.
A couple more as far as ratings are concerned. Credit Suisse upgrading Square this morning to outperform now. Okay.
A little late to the party, but I'll tell you, we talked about this briefly. $70. That's your number. It's a big seller up there. I'm going to go look at the book here once again just to see. But that's going to be your bogey. Can it? And watch out for these setups, that Gil was just saying, where it takes out the seller, 70, it goes 70, 70, 10, 70, 20, 70, 50, and then comes back down through 70. That's what you don't want to see. If it breaks out through 70, you want to see it stay breaking out. That's the definition of a breakout. When it continues breaking out. If they break out and then come back down through the level and start to show weakness, that's a fake out. It could become a fake out. So you got to be cautious about that. So I think 70 gets tested here today. It could potentially take it out. There's a huge seller up there. What it does there is going to dictate the next move. Can it break out through 70 and actually hold it? Or does it break out through 70 and then fail? And then it's set up for a short if that's the case. So interesting day for Square. Is going to be a very important day for it as it tests the $70 level.
Last one I wanted to highlight, Morgan Stanley does not like the lending space. They're downgrading Lending Club and On Deck Capital. Lending Club is equal weight. On Deck Capital is underweight. But that was the only other rating I thought to highlight this morning. That's going to be it for our show. Dennis, you have any final thoughts?
I just want to cover one question in the chat. Matt wants to know my update on Allergan. I still own AGN in my investment portfolio. It's a value trade for me. It's down here this morning. I'm not sure what the headline here is on it. It's been a bad one. I bought this thing at 220. It's been a dog for me. I actually bought it at 220, sold at 240, took another shot, bought at 220 again, and it's just been a dog. But I stuck it in the investment portfolio. I'm probably sticking with it here, although I could get talked out of it there too, although valuation is attractive and, I like my value stocks.
All right, that's going to be it for us today. Thanks to both of our guests for joining us. Thanks to David Miller and Gil Morales. We've got a couple guests on deck for tomorrow's show as well. Andrew Horowitz will stop by at 8:15, I believe, as will Greg Furman from E-Trade FX. He'll join the show at 8:35. If you want to catch any part of today's show again or replay any prior show or catch our podcast, you can go to youtube.com/Benzinga TV and watch the show there, or go to iTunes, SoundCloud, Stitcher, or TuneIn or the Google Play Store, and that's where you can find our podcast and find the full archives of the show dating back to 2014. So that's where you can get that. Thanks to all of you in our chats today on YouTube and PreMarket.benzinga.com. Hope you all have a good rest of your day. And we'll see you folks on Friday. Good luck out there.